All right, friends, welcome back to Market Shares. I'm your host, Tony Blodgett, and I thought today I would kind of do something a little bit different, and I want to go through and answer a lot of questions that I get. Now, I didn't go out and solicit any specific questions, but I talked to a lot of people in mortgage and real estate, and these are just a handful of things that I think a lot of average loan officers, average realtors may not be aware of. So just a few topics that I thought would be relevant to our audience and an opportunity to break things up from our standard market updates and, the interviews that we do. And believe me, I love doing both of those things. But the goal of Market Shares is to just educate and give information after 26 years of doing this industry, all the way from being a loan originator up into many years at executive management. I've learned a lot, and I want to share some of those insights with people. So I'm just going to go through a few topics, nothing really in order here, but just a few things that I know are confusing to a lot of people, and I want to give my perspective on what they are, how they work, and hopefully answer some questions you might have. And if this, sparks any additional questions, please, in the comments down below, we do monitor those. So if there's any questions, comments, feedback, please feel free to leave those below, and we'll do our best to respond to those and or answer in a future episode if there's something that you would like to see us dig into here on the Market Shares podcast. So the first thing I want to talk about is branch structure. So, this is really for our, loan officers out there, branch managers, but really just understanding what is the big difference between a branch manager that is in what I would consider like a traditional retail or, corporate type of a branch structure versus a P&L type structure. And there's lots of different names for what a P&L branch is. Some people will call it a, enterprise branch, or, we call it a partnership branch here at New American Funding. But there's many different, expense management branch is another way of wording it. And there's a couple different ways in which those branches can be structured. And I don't want to get too much into those nuances here today, but really just what's the difference if you're a loan officer and you're working in this environment, or maybe you're a branch manager that's always worked in the traditional retail type of a platform. Like what are the benefits, pros and cons of a P&L branch? And so the first thing that I would mention is that contrary to popular belief, there's not a significant difference, especially to the people that work within the branch. If you're a loan officer and you're working for a branch manager, whether it's a corporate branch, traditional retail, or it's a P&L branch, you probably won't notice a whole lot of difference to the average loan officer. Now, what this type of a structure does, though, is it gives a little bit more autonomy at the branch manager level in most cases. And the reason why it does that is because, in my opinion, the biggest difference between traditional retail and a P&L type of a branch structure is really how it is that the branch manager is compensated. And so because their compensation is more tied to the performance of the branch, therefore, they have a little bit more autonomy on how certain things within the branch are ran. So, for instance, the staffing, the expenses of that branch. So that would be staffing, the amount of money that might be spent on, marketing and different events that the branch might hold. Those are going to be decisions that are made more to branch level than, say, at a corporate level. And then also on the revenue side. So as far as establishing the margins for that branch, like who's setting what the margin is for the actual interest rates, there's a little bit more autonomy, and in some cases, a lot more autonomy at the branch manager level. Now, there are some other things that will govern the margins that can be set. If you're working for a larger company and there's multiple branches in close proximity to each other, there's other considerations that will have to be overseen by the corporate office, because you can't have huge disparity in market rates between branches at the same company within the same MSA, within the same kind of market area. And that has to do with fair lending and other implications of that. But the bottom line is that if you're managing a corporate branch, most of these decisions are being made at a corporate level, right? They're setting the margins, they're determining any pricing exception, flexibility, and they're determining kind of the staffing structure, marketing expenses, so on and so forth at a corporate level versus on the P&L or expense management type of a branch, the branch manager is making those decisions. But then again, their compensation is tied directly to the financial performance of that branch. And so therefore, they may choose to be very liberal in some of the things that they allow, but they might not make as much income on that branch as otherwise would be. Or maybe they manage things very well. It's a high producing branch. They can earn more income than the retail structure might afford them because they're able to control those expenses, set those margins where they'd like, and benefit from their ability to run a great branch. So bottom line, there are some big differences. It's not always a benefit to a branch manager to be on a P&L model, despite what a lot of people think. But for the right person who really knows how to run a business, is very entrepreneurial, and they can manage those things, it can be a great opportunity to participate in some of the upside. Now, conversely, it also can mean that if the branch performance isn't good, you might not get any management overrides, or you may even lose money as a result of that structure. So it's really more of how compensation is. But if you're a loan officer and you're working for a good company with a good branch manager, you probably wouldn't notice the difference either way, except for the person who manages you, who manages the branch location, might have a little more autonomy in this type of a structure. So anyway, that's kind of my feedback on retail versus P&L. That question comes up a lot. The other question that I get a lot is about being a direct seller servicer or a correspondent lender. Now, I'm speaking, of course, specifically to mortgage banking platforms. So as you know, there is banks, there's mortgage banking companies, and then there's brokers. And I'm going to talk about brokers here in a second as well. But in the world of mortgage banking, there's more than one way in which to be a mortgage banker. Either you are underwriting the loans and you're going to be selling those loans at closing to another investor, and companies like Wells Fargo or PennyMac. There's a lot of companies that are purchasing loans in the secondary market. So the difference between being a correspondent lender and a direct seller servicer is that you're still underwriting to Fannie Mae guidelines. So there's not a huge difference there. And I wouldn't say in general there's a gigantic difference between these two ways of doing business, but there are subtleties that mean a lot. If you're selling correspondent, you are underwriting to that end investor's guidelines. It's not just Fannie Mae guidelines. There may be overlays in place on top of that because of what that lender specifically requires. And if you're a mortgage company that is selling loans correspondent, you typically want to have at least 2, if not 3 different investors that you could sell any one loan to. Because if there's a mistake made, or for whatever reason that particular investor doesn't like it, you then have a backup choice. You could send it somewhere else. So if you can think about it from the perspective of the mortgage company, they're actually underwriting each loan to 2 or 3 different lenders that set of guidelines. So that's where overlays can come into play. Now, let's be honest. In today's world, there's not a ton of overlays, but there are some, and they will trip you up, and they will make it so certain loans may not be able to be done as easily as someone who's selling that loan directly to Fannie Mae, as an example. So you're dealing with potential overlays. You're also dealing with the delivery process. So it just takes longer to sell a loan to a correspondent investor than it does to get a loan purchased by Fannie or Freddie. That takes just a couple days. And in many cases, it might only take a couple days selling correspondent, but when it's really busy, if you're in a refi boom and things are really active, or that particular investor that has maybe really good pricing is really backed up, it can take as much as 2 weeks. 18 days. I mean, I've seen it take longer than that when it's really busy, or like when a refinance boom comes out of nowhere. These correspondent lenders can really get backed up. And what that does is it puts a lot of pressure on your warehouse line. All mortgage companies are borrowing funds from a warehouse line. And if you're selling the loan to Fannie or Freddie, you get that money back from your warehouse line really quick because they purchase it within a couple of days. If you're selling to a correspondent who's taking a long time to get those purchases through, that can certainly jam up how quickly you can roll over the funds from your warehouse line and actually drastically reduce your funding capacity as a company. So that's one of the drawbacks potentially of correspondent lending. And then the process of purchasing a loan is a little bit more arduous when you're selling correspondent. There's a lot of, the loan's got to be stacked in a certain order. There's kind of box checkers that go through that loan as it comes in the door. And then they suspend a loan. If there's any documents missing, things not the way that they expect them to be, they'll suspend it. They'll send back to the mortgage company, kind of a suspense notice, and you'll have to clear those certain things before they will go ahead and purchase that. And that process is very different when you're selling directly to Fannie and Freddie. They're just going to take the loan in most cases. They certainly have some quality control reviews they do, but they're not pushing back loans. They're just making note of any deficiencies with that loan and really dealing with it if that loan ever were to go into default. So it's a different process. If that loan defaults later, a lot more gets pushed back. But at the point of sale, it's a less arduous process to be a direct seller servicer. Now, one of the drawbacks is that when you're selling correspondent, you're getting paid in most cases for the servicing value of that loan right up front. And for simple terms, I'm just going to say that the servicing value is maybe 25% of the total value of a loan. So if any given loan, and this will vary depending on the note rate and the duration and all sorts of other things, but let's just say that it's 400 basis points to use really simple math, then 100 basis points of that might be the servicing value. So 25% of the overall value. So if I'm selling that loan to PennyMac, I'm going to get that full 400 right up front, minus some delivery fees and some other small stuff. If I'm selling it to Fannie Mae, I'm only getting the 300 basis points. The other 100 basis points is kind of an investment I'm making in the long-term servicing of that loan. And so in order to do that, I have to then front load my rate sheet a little bit. I have to assume what that servicing value is and put that into my rate sheet, but I'm not realizing that cash right now. And that's why most mortgage companies don't deliver all or a majority of their loans into a direct seller servicer platform, because it's very cash intensive to do that. So when people say, well, why doesn't everyone just retain their servicing if it's such a great asset to own? And the answer is because it requires a lot of investment, and you have to forego a lot of immediate cash in that servicing value in order to do it. So why would you do it? What's the benefit of it? Well, there's a lot of benefits in my opinion, one of which, when you own that servicing asset, and especially in a market like we're in right now, where mortgage originations are way down, a company that has amassed a large servicing portfolio is still getting cash flow, monthly payments, if you will, right? So you kind of forewent the initial upfront, say 100 basis points, but you're collecting 25 basis points annually for the servicing of that loan. And that money is like, it's like mailbox money. It's just residual income that continues to come in for the life that you're servicing that loan. And so in a market like today, it can really bridge some gaps as far as cash flow. So it's a great hedge against a downturn or a really slow origination market like the one that we're seeing right now. The other benefit is recapturing that business when it comes time to refinance. So if I sell the loan to PennyMac, I'll just keep using them as the example. Look, when rates drop, that loan's in their servicing portfolio. And even though the mortgage company that originated the loan still has a relationship with that client, or the loan officer has a relationship with that client, the reality is PennyMac has a vested interest in finding a way to recapture that business. So you have someone new who's the servicer of the loan, who's in touch with the client every single month on their mortgage statement. They're going to be very proactive and quite efficient, frankly, at recapturing or refinancing that business down the road, where in a seller servicer environment, there's no one competing against you. You are the servicer of the loan, so your recapture of the refinance business in theory should go up drastically. So anyways, a couple differences there. And look, I know these are complex topics, and so I'm doing my best to lay this out in a way that isn't confusing, but hopefully you're following along and all that makes sense. So which one's better? Look, there's pros and cons to both, in my opinion. I personally believe that if you can afford to invest in servicing and be a direct seller servicer, in my opinion, that's a pretty significant advantage. There's no overlays or very little overlays. And if there are overlays, they're your own overlays, right? You're the lender. You're the one deciding what those are. You have a higher likelihood of recapturing that business in the future. Your delivery process is much more expeditious. You're selling these loans a lot quicker off your warehouse lines, allowing you to have less warehouse line capacity and turn those loans faster. So a handful of benefits, in my opinion, there. With Correspondent, I think the biggest advantage that you have is best execution. So if you have 5 different lenders that you sell loans to, and on any given day, someone's wanting to kind of buy the market or offer a little bit better price that day because they want to, they have a higher appetite for new business, you can slot that loan into the investor with the best pricing. But sometimes that investor also has overlays. So that can be a potential drawback. So that's direct seller servicer versus correspondent. There is a big difference. And also note this is that many of the large independent mortgage companies in the country, they have the ability to sell directly to Fannie and Freddie. The question you want to know is what percentage of their loans do they actually do that with? And for some, at certain times, it's next to nothing. And others, like New American Funding, we sell all of our loans to Fannie and Freddie directly and retain the servicing. Same with our Ginnie Mae, our government loans as well. Many companies do some version in between. So it just depends on the mortgage company, and certainly something you would want to understand about the company that you're working for, or especially if you're considering making a move, you want to understand what percentage of their business they're doing, selling correspondent versus directly to the agencies, and what percentage they're selling of their servicing versus retaining, and what's their strategy long-term as far as those things go. Okay, so next is, we can touch on broker really quick, just for those of you that aren't super familiar with the different types of models. In the broker world, it's a little bit different. You're actually having the lender, instead of underwriting and funding the loan and then selling it, like I was talking about with correspondent lending, you're actually having that lender underwrite the loan. So you're basically taking the application for the borrower, you're finding an investor that you think is going to offer a competitive price, but also doesn't have a lot of overlays. You send it to them, they do the underwriting of the transaction, and then they actually fund on that loan. You're just kind of facilitating the putting together of that transaction. So it's a very different structure in that the company you work for doesn't make any of the credit decisions on that loan. You're just helping to find a lender to provide that underwriting and funding service, and hopefully, they don't have any overlays and it works, because you can't just switch it to another lender. Well, you can, but then you have to completely relock the loan, go with a different lender. It's just a different process. I don't want to say it's better or worse. It's a different process than if you have those relationships with multiple banks or if you're selling direct. Okay, so benefits of servicing. I kind of touched on what the benefits of the servicing were. The other thing that comes up next is portfolio. Like, what is a portfolio and what is portfolio lending? A lot of people think because you might be a direct seller servicer, so you're funding loans, you're selling direct to the agencies, you're retaining servicing. A lot of people think that means that you're a portfolio lender as well. And I want to dispel that myth, because it is a completely different thing. Even if you're a direct seller servicer, you're still selling that loan to Fannie, Freddie, or securitizing that into a Ginnie Mae security. And you're getting, in my previous example, 3/4 of that money back when you sell it to Fannie or Freddie. The other 100 basis points or 25%, that's just the servicing value of the loan. So essentially, you're servicing that loan on behalf of Fannie and Freddie. So they're buying the actual loan, the security, and you're keeping the right to service that loan. that does not make you a portfolio lender, okay? That just makes you a direct seller servicer. True portfolio lending is when you have a pool of money, your own money. You're not using Fannie Mae or Freddie Mac or Ginnie Mae. You're not going to securitize these loans and sell them on the secondary market. You're like a bank and you have your own funds that you want to lend out, and you're going to lend out that at whatever interest rate you want, at whatever terms you want. You decide what the guidelines are. That's why these can be very flexible in the different products that are allowed under portfolio lending. And then you collect the interest on that loan every time. So you service them, you decide what the guidelines are, and you're using your own money. If you're a bank, you're using someone else's money, right? You're using your depositor's money or some other money. But essentially, the institution controls that money, and they're not selling that loan to an entity like Fannie, Freddie, or Ginnie, if that makes sense. So big difference between being a portfolio lender and being a direct seller servicer. A lot of people get those two things confused. And I would argue that I don't even know of one independent mortgage banking company that truly does portfolio lending. Many of them will partner with a bank and they will have like a white label portfolio product, but they're using the bank's money. The bank is servicing those loans, or like in our case, we have a relationship like that. We actually do service the loan, but we're not the person. The bank is lending the funds. We helped write the guidelines. They agreed to them, but most independent mortgage banking companies that I'm aware of have some sort of a relationship in place. If they're offering an in-house portfolio product, it's usually in partnership with a bank that has a lot of funds available that they want to use them as kind of the vehicle to get those products out into the market to utilize that money that they have. So that's portfolio lending. It's very different. And the last thing that I want to touch on here is locking in an interest rate. And this is a very confusing process, and I'm not even going to try to go deep into explaining how locking an interest rate works. But I wrote here in my notes, like, what's the big deal? And what I mean by that is I constantly get asked, like, hey, I locked my loan, 2 weeks ago, and you guys charge a fee to be able to change the program, for instance. Like, why is there a program change fee? Or like, what's the big deal? Why, rates have gotten better since I locked in this loan. Why can't I just go to today's interest rate? Like, what's the big deal? There's a lot of confusion as to what locking an interest rate does. So I just want to give a quick overview on this, and then we're going to wrap up this episode. So one thing to understand, almost every mortgage banking company that I'm aware of is hedging their locks. But before I get into that, let's talk about what it looks like if you don't hedge your locks. So let's just say you're a correspondent lender. So we'll go back to using PennyMac as an example. So if the loan originator meets with the client and the client says, I want to lock in my rate at 6.5%, then the loan officer will then turn around and lock that interest rate. And if you're not hedging your loans and you're selling correspondent, then you will lock actually directly with that investor, in this case, PennyMac as an example. And that's what's called a best efforts lock. So you're not getting the best price in the world. You're getting a pretty good price. But if that loan falls out and doesn't close, no one loses anything. Well, PennyMac might lose something, but no one, it doesn't cost the borrower any money. The mortgage company and the loan officer, they're not penalized. So they just do what's called a best efforts lock. And if the loan closes, then the investor honors it. If the loan doesn't close, it just goes away, essentially. Now, if you do that too often and your pull through is really low on those, then you're going to have investors that are going to penalize you, and you're not going to get as good of interest rates from that investor if you're routinely breaking locks or not delivering on lock loans, even with a best efforts type of an arrangement. It's going to hurt you in the long run. But that's best efforts, okay? That's where you're not hedging. I don't know of any mortgage companies that are doing the majority of their locks best efforts. Most of them have a more sophisticated capital markets team that is essentially when the client locks their rate, The loan officer submits the lock into their lock department. And instead of locking that with an end investor, they're just taking out a hedge position against that lock. So they're essentially looking at, okay, where is this loan in the process? Maybe it's just the file just started. Maybe they're at application stage. Maybe it's being locked and it's actually all the way through underwriting, and it's basically at the approved milestone, right? It's been approved by underwriting. Those two loans are going to be looked at differently by your lock desk, because your lock desk is going to have some assumptions on what is the likelihood that this loan is going to close based on the stage in which it's at when the lock comes in. And then as that loan moves through the different stages, the different milestones, they're going to put more and more hedge protection against that lock in case there's market movement. But here's the important thing to understand is that when that lock comes in and it gets sent over to the lock desk, they're taking out a position that operates in inverse of what mortgage rates are doing. So meaning if mortgage interest rates get worse, their position gets better. But keep in mind, they haven't sold that loan yet. And so by the time that loan gets to closing and they sell it, if rates are a lot higher than they were when they took in the lock, they don't have a choice. They have to sell that loan at that higher rate, but they can't give the client a higher rate. The client is locked in. So this hedge took out a position in inverse of that, and they would have made money on the hedge while losing money on the lock, but the two tie out and they're able to deliver to an investor a loan that's actually funded. And unlike a best efforts delivery where you're not getting the very best pricing, the best execution, when you're selling whole loans that are funded, you're getting the best price possible. And so the reason you might be asking, well, why do people even do this whole hedge exercise? It's because when you sell that loan that's already funded, you're getting the best price possible. And there's other things you can do that. You can pool multiple loans together and you could get even a better price potentially for those loans. You can pool them together. You can pool certain types of loans, different percentages, different note rates, and you can sell those into the secondary market and maximize your revenue on those loans. So it's worth the investment in hiring the people to do the hedging. And there is some risk in hedging. If you're off on your numbers, if you don't have a very sophisticated process of analyzing your pipeline and the market moves significantly and you have a percentage of your loans uncovered, it can cost you a lot of money as a mortgage company. But by and far, the goal is to break even on the hedge and then make a little bit more money when you ultimately sell those loans into the secondary market. So you might ask, to my original question, what's the big deal? Well, the big deal is if you take in that lock, even though that loan is really just sitting in the hedge, there's been a position taken out against it. And there's assumptions made about that loan. The type of investor that it is, the type of loan, FHA versus conventional versus VA, so on and so forth. And there's different nuances to how it is that they took out their position there. So when you make a change to that loan, you significantly change the loan amount is a good example. Now I might have too much coverage or not enough coverage on that hedge and the market's moved. Well, now the mortgage company is taking risk there or changing the product. The pull through might be different. Maybe you're starting the loan over. And so it's hedged over here at 80, 90% because it was ready to go to docs. But now all of a sudden it's back to a beginning milestone. For whatever reason, it had to go back through underwriting, things change. So all those things impact the mortgage company, the lender. And so they're going to charge a small amount for those changes to your lock. So when you think about what's the big deal, hopefully that helps you understand at least a little bit of the complexity that's going on behind the scenes in your lock department. Again, I know it's a complex topic, but it's one that I think everyone should understand. And that's the thing with all of these topics I touched on today. Look, I understand that these things aren't simple to wrap your mind around. And maybe you're a newer loan officer. I know we have a lot of newer loan officers that watch Market Shares because I hear from you guys. And maybe these are concepts that you're just now being introduced to. Or you might say, look, I'm not a branch manager. These things don't matter to me. I don't work in capital markets. What do I care? Well, in my personal opinion, I think that as a loan officer, even as a realtor, you should want to know how these different areas of the mortgage process work. And that's why I'm committed to bringing this information to you guys. If you like this episode and you like these kind of topics, please give it a thumbs up. Like, let us know that this is resonating with you. Share this with someone in your office or another loan officer or realtor that you might know as well, because growing our audience is, one of the most important things that we can do. So that, look, don't get me wrong. I love coming in the studio, making this content. There's no question. This is fun for me, but I'd like it to be educational for as many people as possible. And I can only do that with your help. So like, subscribe, share this content, leave in your comments, your thoughts down below. I hope this was an enjoyable set of conversations. And if there's anything else that you would like to dig deeper on here in Market Shares, like I said, let us know. I'm not afraid to peel back the onion on other complex topics if they're things that people have an interest in. And until next time, you guys, thanks for your time and attention as always. And we'll see you on the next episode of Market Shares. Take care.